Greetings, members, one and all of the Salivation Nation, with day 2 of a wild stock market and, by extension, gold and silver. And, of course, what you're looking at here are the live prices on Kitco for gold and silver. And you can see there's not a whole lot of activity other than that silver is dropping by 30 cents and gold is down slightly. Now, what does this mean? This is actually a good thing in a way because people running to the safety of cash, which means that gold and silver are not really taking the hit that the stock market is right now. The stock market is down 736 points. That's over 2% on the market. So you look at that here as we're looking at this in real time, compared to what the gold and silver are doing. Silver is taking a bigger hit than gold between the two metals, but even it is not dropping it's dropping half as hard as the Dow Jones is right now. So why is this happening? Well, people again are running to the safety of cash. That's right. That thing that's been inflating by 7% year over year now, people are running towards it, kind of like they did in March of 2020. There's concern. And that's what people know. Cold, hard cash. The vast majority of people that way, anyways, regarded to the stock market and those who are investors, that's what they know. They know the dollar and nothing else. But we understand sound money, gold and silver. And so when they can't make money, they run to preserve their money as best they know how, and they run to the safety of cash. With over a 2.1% drop out of the open, less than an hour into the open of the market. And what happened yesterday is quite concerning because it was a pickup, a turnaround. And that turnaround has caused some questions. I'm looking at an article here from Bloomberg that talks about the strategists predict trouble for the U.S. stocks after a massive U-turn. This article being posted for a post-mortem of yesterday's activity gives us some insight as to what's happening here from a couple different vantage points. Monday's U.S. market action was wilder than most in its history, with the S&P 500 falling about 4% before ending slightly higher. You did not see gold and silver drop that much. That means that they are preserving some semblance of sanity in an insane world. While positive turnarounds are often viewed as a good sign, that might not be the case here. And this morning is evidence of that. According to calculations by Bespoke Investment Group, Monday was the 6th time since 1988 that the Nasdaq erased 4% plus intraday decline to close higher on the day. On previous occasions, the tech-heavy gauge saw a medium decline of 5.5% 1 month later and a drop of 7.9% 3 months down the line. So yes, wow. As investors try to gauge the impact of everything from the Fed tightening to the impact of the pandemic and geopolitics like Russia-Ukraine, markets are becoming more volatile. We're seeing that today, right now. The volatility index closed just shy of 30 compared with its lifetime average around 19.5. Strategists tracked by Bloomberg are still bullish, and their average forecast of the S&P is at 49.82 by the end of the year compared with its Monday close of 44.10. But since the gauge narrowly escaped a correction on Monday, many market watchers are likely pondering their expectations. What is this Fed put here? Some of these voices are saying what's happening here. The Fed put, examining the rare exercises of the Fed put market by extraordinary announcements or unexpected forceful actions. 1987, LTCM in 1998, 2001, tech bubble burst, 2008, GFC, 2019, the Powell pivot, 2020 pandemic rescue, and the average exercise price is a negative 23.8% peak to rough, equating to a current SPX 3670 and approximately to our 2022 downside scenario extreme of 3575. Despite the first signs of stabilizing stocks on Monday, Powell's speak may be interpreted cautiously as investors did throughout the chair's first uncomfortable year in office. Before becoming more at ease after the exercise of the Powell pivot put in January of 2019, Emmanuel continued, given the steep skew, expensive downside puts, relatively inexpensive upside calls, investors wishing to gain exposure to the S&P 500 while factoring in the potential for sustained elevated volatility could go long the June 30th 4740 call. Well, anyways, you get into the technicalities of that. But nonetheless, another take is a clown stocks to fall 90%. Felt like a near-term bottom. The Fed meeting this week is probably an upward catalyst, said Brian Barish, Chief Investment Officer at Cambiar Investors. Beyond this near-term trading setup, it's clear that the very high multiple and intentional plan to lose money now because the future is huge business models, these stocks are in big trouble. The valuations for these kinds of things have continued to migrate upward for the last 2 to 3 years, and some return to reality is in order. There's another class of stocks, more of the small cap speculative stuff that have little value relationship with, it seems, anything. I've been calling these Robin Hood stocks. Jim Cramer calls them clown stocks. It's clear that these are in the bear market. The clown stocks could lose 80 to 90%, like NASDAQ in 2000 and 2002. I don't think that's crazy to imagine. It certainly could, but it could take other stocks with them. And again, I'm going to go ahead and probably make this prediction. I came very close in yesterday's video, but considering where we are at and watching this morning drop now, 600 points, is trying to recover it again here. But that's just too much volatility. It was down over 700 points earlier. Now we're trying to see it kind of make a comeback here as we watch this thing as I record this video. So it is interesting to see. And I think this has got the Fed nervous. I believe that they're going to make an announcement when they meet this week for a rate hike. I think they're going to try to do a quarter point increase now. This week they're going to announce it. I believe it may happen before the March. We'll see. They'll either announce it as definitely going to happen in March, or they'll go ahead and just do it. One of those two, I believe, is going to happen out of this meeting. We'll see. I could be wrong. Some say that they wouldn't dare raise rates in this environment, but we'll see what happens. I believe that it's going to probably happen. What else do they have to do? They're losing control, especially in a volatile market like this, because even if the market completely recovers out of this steep drop, out of the first 45 minutes of the market opening, to me, that sends a strong, powerful message. Day 2 of this going on, this is crazy. So we just saw what potentially could have been the bottom today, early in the morning. We'll continue here. The low may be in, as the next voice here. The most aggressive tactical indicators have flashed a trading day signal, reached negative extremes, and positively inflected intraday today, said Brian Rauscher of Fundistrat Global Advisors, head of global portfolio strategy and asset allocation, in a note. This is similar to the behavior we saw in both 1226 of 18 and 323 of 20 trading lows that saw the S&P 500 get slammed on a Friday option expiration, only to find a trading bottom that followed Monday before noon. My work suggests that a trading low is likely in, he continued, adding that he is less certain that the first half low has already been reached in its pricing in the Fed, inflation peaking, and COVID rolling over haven't run their course yet. So it looks likely that there is some opportunity for aggressive traders as well as strategic investors to use the expected bounce to look for higher quality stocks that have been overly sold off. And you have unwinding leverage. There's no question that the ride has been a wild one recently. The chief market strategist at Miller and Tabak and Company, today's bounce was an impressive one, and we did see some signs of capitulation at the midday lows. The volume was strong and the breadth was very negative, and we did see signs of forced selling, like margin calls. This should allow the bounce to last for more than just a few hours. That said, the amount of leverage that has built up over the past several years will likely take longer to unwind. Therefore, I think we have moved into a period where investors should sell their rallies rather than buy the dips. Then you have the head fake. The S&P intraday relief rally on Monday was a head fake. The index completed an almost perfect intraday inverted head and shoulders to end the day out flat. The strategist Barry Bannister-Streifel. Bannister says a number of things need to take place for a stock market to occur and the bull market to resume, but none appear to be in the offing. They include a dovish Fed pivot that lowers the 10-year TIPS real yield, a bottoming of the U.S. manufacturing PMI, and a bottoming of the S&P 500 quarterly. EPS beats minus misses, which has faded since the third quarter. Then you have the missing skew. S&P skew, a skew of buying power in general, remains weak and low even as we are selling off hard, said Amy Silverman, equity derivative strategist at RBC Capital Markets. Part of the reasoning and part of this feels a bit worrisome is that folks are just not as long and simply don't have much to hedge. Instead, investors are not demanding downside protection because they are taking money off the table instead. Interestingly, even as rallied back this afternoon, S&P normalized skew levels remain close to one-year lows across all tenors. And then you've got JP Morgan, what they say, that the pullback was overdone. All right, isn't that interesting? They say that the market worries around rates and corporate margins are overdone. They said in a note, recent pullback in risk assets appears overdone, and a combination of technical indicators approaching oversold territory and sentiment turning bearish suggests we could be in the final stages of this correction. While the market struggles to digest the rotation forced on by its rising rates, we expect the earnings season to reassure, and in a worst-case scenario could be a return of the Fed put. So there you go. And there, we watch this thing as we see the market now start to recover from its drop over 700 points earlier in the day, in the morning here, and we're starting to see it climb back up very steadily. So we'll see here. Gold and silver, by the way, now gold is flatlined as we see this movement. It's starting to kind of recover there. People are starting to think, okay, well, hey, we can get to normal again from day two of this great insanity. Volatility will rule the day. The precious metals will be affected probably to the downside during these courses until it really takes a pretty big hit. And that very well could happen like March of 2020. And then we see gold and silver drop because people run to the safety of cash. Interesting nonetheless to watch and see. But regardless, I think the lesson here, folks, is gold and silver are going to be there for us and be a stable form of wealth preservation. As we watch these markets recover in real time, this V pattern in the morning, we very well could see them zeroing out by 11 or 12 o'clock. What a day so far. Interesting indeed. Let me know what your thoughts are in the comment section below. The lesson here is to diversify with gold and silver and have the physical form in your stack. A multitude of gratitude to you all for taking the time to watch, and I want to encourage you to please rate, share, comment, and subscribe.